Ladies and gentlemen, another ugly day. The Nasdaq 100 down nearly 4%, Tesla crashing down 15%, defensive stocks catching a bid, and Mondays from here on out on this channel in 2025 will be known as Bloodbath Mondays. But now comes the question, when do we bottom? And if we do we go back to all-time highs? That is the big question I will answer on today's video. All I will do today is provide you the facts and the data about why we're crashing and what comes next. That is it. So if you haven't already, call your mother, tell her you love her, and let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and US stocks plunged on Monday as investors processed growing concerns about the health of the US economy after President Trump and his top economic officials acknowledged the possibility of a potential rough patch. And it was very red today. The only green we saw was in these defensive names. Look at utilities, very, very green, outperforming the broader market. Look at staples, right? So consumer non-durables, or like the actual defensive component of the consumer staple sector, they were kind of flat to green. However, the growth component of staples, look at stuff like Walmart, Home Depot, Costco, they were pretty red. Home Depot outperforming, but Costco down 3%, Walmart down 4.2%, even Lowe's, TJX, Target, they took it on the chin today. Energy caught a bid because of some geopolitical concerns, stuff that's going on in Syria, and then communications, specifically telecom services, they caught a bid. They tend to be very defensive. But other than that, it was red across the board. Look at technology in the hardware space. Look at technology in the software space. Deep red. The mega caps leading the selling lower, and Tesla leading the mega caps lower, down 15%. And it was selling everywhere, in financials, in commercial services, in industrials. Berkshire did catch a bit, but that was about it in terms of green stocks. It generally was just risk or fever. We saw the S&P 500 down 2.66%. Gold was down 0.88%. Even staples lost today, down 0.2%. These are the GICS sectors. But we did see utilities and energy. They were the only green sectors today. And really what we saw today was a liquidation and a very mild rotation into defensives / safe havens. And we'll talk about what treasuries did in the chart component of the market. But technology leading the selling along with discretionary. Communication services down 2.5%. Financials, materials, industrials, healthcare, real estate. Very, very ugly day. Today was not the day you want to be in the market. Today was a day where you just don't look at your portfolio. Maybe deploy a little bit of capital into your ETF indexes and call it a day. Very ugly day, and it was across the board. The outperformance did come from value here in the large cap and mid cap components, down 0.92 and 1% respectively, but still very, very red, all things considered. And the worst performing factor and size segment was actually large cap growth, down 4%. And then small caps, mid caps, this entire market really taking it on the chin. And that was the same case globally. North America was very red. South America was very red. Europe was red. Asia was red. There was no place to hide in the equity market. And it all has to do with economic growth. The market is trying to figure out what Trump's policies are going to mean for the economy. Trump has declined to rule out a recession, but the market is seemingly trying to price that in respectively. Betting markets looking at recession risk well above 50%. We also did have some tariff escalations today. Ontario set a 25% surcharge on energy exports to the US to counter Trump's tariffs. Doug Ford said the province won't back down until US president retracts duties on Canada. I think this guy is playing very, very dumb games because he is just a premier of a state, but we'll see how Trump reacts to this. I don't think he's going to look at it very, very favorably, and I think he's going to retaliate very, very strongly. That is just my opinion. Now, Tesla, a huge market mover, down 15% today, officially below the Trump election price. It's been very, very ugly. Tesla has wiped out $860 billion of market cap. The stock literally went from 430 to 220. It's nearly halved in price. It's absolutely insane. And I think Tesla might go lower. If Musk is not there to manage his companies, I think the market is going to lose more and more confidence. Definitely not a stock you want to be in. Out of all of the names, Tesla's definitely where you don't want to be. Oracle was kind of flatlined, down 1.3% today, but it was positive here in the after hours. It reported its earnings. And there wasn't much to say about their earnings. It was pretty good earnings, a double beat, a very slight raise, but even Oracle wasn't immune from the sell-off. But we'll see what Larry Ellison and his team have to say on the conference call. Nonetheless, I had a very brief look at it. Oracle's earnings was actually pretty good. And in aggregate, we actually saw outflows here in the markets as a whole, exemplified by the Nasdaq 100 seeing peak outflows, the S&P 500 down 2.7%, very ugly day in breadth, only 1,100 advances, 5,100 decliners, brutal price action, and market momentum continues to remain sour. And shorter term, medium term averages telling us to stay wary on this market. Now, stocks were a dumpster fire across the board. The S&P 500 down 2.7%, but the Nasdaq taking it on the chin, down nearly 4%, absolutely crazy. The RSP down 1.41%, so we definitely saw outperformance in the broader market. The IWM as well down 2.52%, so I think a lot of the selling here was by something like Tesla, really detracting from the overall index in the Nasdaq 100. Mid-caps and small caps fell in equities as a whole, was a very risk off. We saw value outperform growth, and we did see yields across the board fall, and the dollar was kind of flat today. Now, very interesting, we saw volatility tick up in a very big way, up 19%. But if you look at the forward month contract of the VIX, it's down. It's actually at 22 versus 27. This is essentially telling us that spot VIX is higher than the front month contract, meaning that the volatility we're seeing in the market has an expiration date. That is what happens when we actually see the front month contract lower than the spot VIX. That expiration date comes at the next quarterly OPEX. When is the next quarterly OPEX? March 21st. So this March OPEX is actually a quarterly OPEX as well. So that's why I'm very confident we should see some form of an interim bottom put in, and then we should see some form of a reversal. Now, I don't know if we'll go ahead and hit and take back the highs, but around about that March OPEX time period is when we should see a bottom put in the markets. Now, like I said, yields did fall. The dollar was kind of flat today, and again, that is just on the back of weaker than expected economic growth. Look at the 2-year yield, officially below the 4% mark. Very strong move we've seen right there. The 10-year yield at 4.2%, 30-year yield at 4.5%. Bonds gained as a result. Bitcoin fell. It was risk off today below the 80% mark, and then we can see here that gold, silver, and commodities were mixed as well. Now, the S&P 500, absolutely crazy price action. We are in a daily downtrend, and we actually saw the put support, the gamma flip, and the core resistance all move down in a very material way. So definitely the bears winning right here. We are officially below the Trump gap up, and we're officially taking out some of these very key levels. The next level of support is this level right here, right below the put support. I think we can definitely find support at these levels. If you actually go ahead and draw like a rectangle right here, this is sort of like 54 to 5500 area. This is actually where I said we should find support if we do continue the selling, and that could coincide with us finding support at around the March OPEX period. That is a very key moment in time when we will turn around, especially as it pertains to the VIX as well. Buyers definitely did come in here at the end of the day. We did see a massive wick, so we did see dip buyers come in a very material way. However, still red for the day, still a very ugly day, still in negative gamma even after we moved lower. Really goes to show the volatility we're seeing here in the S&P 500. It was the exact same for the Nasdaq 100. Everything moved lower. We're in negative gamma, and I think the Nasdaq 100 has a long way to go with regards to the selling before we put in a bottom. We're looking as low as the 18,500 area. We're in a clear downtrend, guys. Longer term investors should be looking to buy the dip and take opportunity in the names that they like. Shorter term investors and swing traders should play it a bit more cautiously. Nonetheless, we are in negative gamma, so we do aim for the bottom end of the range. That is 54.85 for the S&P 500 and 18,500 for the Nasdaq 100. The RTY, pretty ugly day as well. As you can see, we're sort of in negative gamma here in the middle of the range. Now let's go ahead and measure peak to trough. So this is pretty much all-time highs for the RTY. Peak to trough down 19.14%. Now this is the Russell 2000 futures. It's not actually the IWM, but we can go ahead and measure the IWM. This is the actual exchange traded ETF. It's down about 18%, so not much difference between the futures and the IWM. Looking at the Nasdaq 100, again, peak to trough from all-time high. not to close, peak to trough, guys, down 13%. Very, very ugly move. And then the S&P 500 is probably going to be close to 9%? Yeah, 9.53%. So nearly in a correction. To be honest, I still see this as a very orderly pullback. There is growth concerns, there is growth scares, but I do think what's going to happen is that we're going to see some pretty good inflation data this week. And that's going to really give the Fed the power to cut rates. And we're going to see some very, very positive rhetoric out of the FOMC. And again, that's going to coincide with that March OPEX. There's a ton of factors as to why I think, this March OPEX, March 21st, March 20th area could be a potential bottoming zone in terms of a date. In terms of price, that's a little bit harder to determine. March OPEX is where we could see at least a turnaround or some form of support come in the equity markets. What's also supporting stocks almost immediately here in the near term is stuff like yields, right? The 10-year yield, it looks like it's going to continue the downtrend it made. So we sort of pulled back, put in a high, a higher low, then very much the same. We put in a low, put in a higher low, right? So from here, if we go ahead and break this 4.152% mark, it then means we will see a trend continuation. Very, very constructive price action for yields to actually go ahead and break the 4% mark. But what we really need to do is see a continuation in the 10-year yield. But what Besant and Trump want is a lower 10-year yield, and they've got it so far. This was the price on the 14th of January, right before inauguration. And you could see yields moving lower as a result. And that is the case with the 30-year yield as well as the 2-year yield. The 2-year yield officially closing below the 4% mark. Very, very strong. And I mean, from a liquidity basis, this is probably the next level of support. That's around the 3.6% mark. Now, TLT, I said you guys actually want to take TLT longs. This was sort of near close to the start of February, and we've seen TLT move up as a result. And I think this move is probably going to continue. I do see probably a 95 TLT level probably within the next month or so, especially as the yields continue to move lower. There is definitely that austerity happening with this Trump administration. Austerity leads to weaker economic growth. Weaker economic growth is normally reflective in lower yields. As a result, bond prices get bid up. That inverse correlation existing as well. Gold, guys, interesting to see. We are consolidating here at this top end of the range. So we probably found the area where we are going to consolidate right here between the 2800 and 2900 area. I would love it if we got to this 2700 area. This is where I would buy very, very viciously based on Trump and Besant's plans to revalue the gold reserves. And my prediction is they're going to use 2700 as their revaluation metric. That would bring about $800 to $900 billion back into the US economy via a repurchase agreement. That is obviously like the absolute bull case for gold. We'll see if it pans out. If it does, this is virtually the bottom for gold, the floor. From here, it's onward and upward. So hopefully we get there. We just got to be a bit more patient with this. Nonetheless, if that doesn't happen, gold is looking a little bit overvalued at the top here. And I'm going to speak about why I think gold is overvalued on my second channel, FinFluential Media. So if you want my opinions on gold, go ahead, follow me on FinFluential Media. That video is going to be out a little bit later today. It's normally about 5 or 6 hours after I post these. You get the FinFluential Media videos. Now, the dollar was actually down 0.22% today, and we are at this very key area, and you could see that we found support. This was the key area I outlined at the start of this year. I said this was the key area. We broke below. Now we're kind of finding support. We're not seeing these big red candles. We are seeing wicks right here. So dollar bulls are coming in, and I do expect us to continue to find support. Okay, and then we'll make our next move. If that's a break lower, we can then go ahead, target the $100 DXY. If not, we'll go up, and then it looks like 105 is the next area that we'll go ahead and see a little bit of strength in the dollar. Nonetheless, everything is looking a little bit ugly in the equity markets, but there is some support, and I think we are going to see continued selling in the equity markets up until this March OPEX, and then from there, we'll make our next move. Now, I'm not saying that March OPEX is going to be the absolute bottom. We can definitely go lower. I'm just saying that if we are to find support, it's likely going to coincide with that date, because that is also when we get some key economic data as well as the FOMC. So all of that is telling us that that's when we could find a bottom or support or consolidation. Nonetheless, guys, I am still bullish on US equities for the most part. You know what's the craziest thing out of all of this? Earnings expectations haven't really budged. So the consensus earnings estimates are roughly down about 1% year to date. That's the downward revision we've seen. The S&P 500 is down about 10%. So, and if earnings continue to hold up in this very material way, this is definitely a buying opportunity, but we will continue to monitor the earnings picture as well as earnings revisions, because if earnings turn, that is when the selling can get very, very ugly. But in the year and now, earnings haven't turned, especially in the S&P 500, and this is an opportunity to buy the dip, and the dip being between the 54 and 5500 areas right now. Remember, we said you want to buy at the neck at every 5% interval. So the first 5%, I said you want to be adding. That's exactly what we did. The next 5% area is kind of here where we are right now. I would say closer to the 54 to 5500 area. That is our next leg where we buy the dip, guys. It's all a part of the process, all a part of the plan that we follow here on this channel. So get cash ready. Don't deploy everything, but I would really start looking at buying equities that you like, especially S&P 500, Nasdaq 100. I still have my bull case target for the S&P 500 at 6,600 for 2025. That hasn't changed. If it does change, I will let you know. But in the here and now, guys, stay constructively bullish and just sit through the volatility and enjoy the pain. We are still in a bull market, and these types of pullbacks completely normal. It just feels very painful because we've had 2 exceptional years in the US equity markets. However, I am still bullish, continue to remain bullish, but in the here and now, expect some short-term pain.
And guys, diving into sentiment, this is Goldman Sachs US Equity Sentiment Indicator, which combines 9 measures of positioning across institutional, retail, and foreign investors, and has historically been a statistically significant signal for near-term S&P 500 returns. Pretty much, if you're above the 0 line, positioning is slightly higher than what it was last year, below, and its positioning is slightly less. We are sitting at the 0.02% mark. Now you can see that we did see a little bit of an uptick compared to last week. However, we're still below the 0 line, and that probably does indicate to us that we should expect maybe not downside, but definitely some churn in the overall equity markets. And if the current pullback is going to develop into a correction, it should happen relatively quickly. Historically, 76% of S&P 500 corrections play out within a 60-day window. That would put us to about the early mid-April timeframe. In other words, what we really should see is a very, very quick move into correction territory. That would mean a move greater than 10%. It would put the correction at about this point right here. This is the 10% mark. We should see a very, very quick move into mid-April, and then we should see a move onward and upward. If that isn't the case and we don't see this vicious move very, very quickly over the next couple of weeks into correction territory, expect the S&P 500 to sort of consolidate here and then make the next move higher. Just remember, guys, that top formations in stocks tend to be like these long drawn out processes, and bottoms tend to be events. Bottoms happen very, very quickly. Top formations can take months and months and months. And that is why I say deploy capital at every 5% pullback. That way you don't miss the move up, because they can be very, very sharp. However, with this pullback, there's actually been some very interesting developments in the overall earnings picture in both the S&P 500 small caps and mid caps. Now, like I said, the S&P 500 has had a pullback of about 7%. We've seen a slightly bigger pullback in tech stocks as well as small caps and mid cap stocks. However, if you actually look at the overall earnings picture, S&P 500 earnings, we've actually seen year to date only a negative 1% in overall revisions. Now, this could change. However, in the here and now, based on the data we have, the earnings picture for the S&P 500 analysts haven't seen a major change. So the S&P 500 has pulled back 6%, but overall aggregate S&P 500 earnings has actually only pulled back 1%. And look at tech stocks right here. In fact, tech stocks are down about 13% from their highs. The aggregate index, we've seen names like Nvidia down 23, 24, 25% from their highs. However, there's been no EPS revisions year to date for the tech sector. So when we see this recovery, when tech stocks make a recovery, when the markets recover from these lows, expect a violent pullback. We've seen a very similar situation here in mid caps. Mid caps are off about 10% from their highs, and we've seen S&P 400 earnings only about 2% in revisions year to date. It's looking a bit ugly for small caps. We've seen negative 5% in earnings revisions, and S&P 600 small caps are about 8 or 9% of their highs. So that does make sense, but this doesn't make sense as well. And have a look at this. Financials have actually seen year-to-date upward revisions, and financials are actually still quite off their highs as well, at least. So if you are looking for value in this pullback, definitely look at financials because they still trade at a relatively cheap valuation, in my opinion. But I think one thing that is influencing the market right now is actually the macro. The macro data has come in very weak in the last couple of weeks. None more exemplified than Atlanta Fed's GDP now. This is a forecast for Q1 GDP. We were, here in mid-February, late February, looking at about a 2.3% GDP print. But after seeing massive amounts of imports, which subtract from GDP, these are businesses front-running tariffs, we saw GDP pull back to as low as 2.8%, currently sitting at about negative 2.6%. However, this is utterly ridiculous. And what we really should be looking at is final demand. Final demand is what really matters. If you want to see a recession, this has to go into negative territory. We haven't seen that. However, what we have seen is this pullback. So we are definitely seeing an economic slowdown, okay? But we're definitely not seeing negative GDP growth, not yet. And I don't think this means we're going to see a recession in the US economy. However, we are seeing a slowdown. We saw that in the jobs print. We actually saw the unemployment rate tick up to 4.1%, and we saw the non-farms number actually miss. We were expecting 160,000. We got 153,000, missing expectations ever so slightly. So the job market is cooling. The economy as a whole is cooling. And the majority of this miss was actually federal government employees. Government employment payrolls actually decreased by 10,000 here in the month of February. However, in aggregate, residential construction payrolls remained relatively flat. This is a great parameter for the overall economy and the employment market. It's flat, so it's still not indicating that a recession is imminent. And this all still points to an underlying growth scare we're seeing in the market right now. Looking at data, eyes are all fixated on the data because right now, the macro data is really driving momentum in the economy. But everything that Trump does is tied to the macro data. So tomorrow we get the JOLTS jobs opening. So this is going to be a very, very big one. And then for the remainder of the week, we also get like inflation data, PPI data, sentiment data, and also initial jobless claims. But tomorrow we're looking at the JOLTS jobs opening. We're looking for a 7.5 million figure. Very, very key. There's a whole report that comes out with JOLTS, and we're going to cover that in tomorrow's video. Looking at earnings here for Tuesday. Now, before the open, we get Dick's Sporting Goods. I believe that's about it. We do get Kohl's as well. Those are the two big names, heavily tied to the consumer. And then after the close, you have Casey's and Groupon. That's about it. The big names like Adobe are still to come, Path, SentinelOne, and then we did have Oracle today. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.